Trump's tax reform is making headlines again, and these 5 deduction changes could dramatically impact your finances in 2025. Let me break it down for you. First, the elimination of personal exemptions. Previously, you could deduct about $4,050 for yourself, your spouse, and each dependent. That's completely gone now. For a family of 4, that's over $16,000 in deductions, vanishing overnight. This hits large families particularly hard. The more dependents you have, the more you're losing under this change. But wait, there's a trade-off. The standard deduction has nearly doubled. Singles now get $12,000 instead of $6,350. Married couples filing jointly, your standard deduction jumps from $12,700 to $24,000. This means if you weren't itemizing before, you're probably coming out ahead. About 70% of Americans take the standard deduction, so most people will benefit from this simplification. Third big change: lower individual tax rates across the board. The top rate has dropped from 39.6% to 37%, and most brackets saw reductions of 2 to 3 percentage points. For example, if you're making $80,000 as a single filer, you were in the 28% bracket before. Now you're in the 24% bracket. That's thousands of dollars staying in your pocket each year. However, not everything is a tax cut. The fourth major change puts new limits on itemized deductions. The biggest hit? State and local tax deductions are now capped at $10,000 combined. If you live in high-tax states like New York, California, or New Jersey, where residents routinely deducted $20,000 or more, this is a significant blow. About 11 million Americans will feel this pinch directly. Additionally, mortgage interest deductions are now limited to loans of $750,000 or less, down from $1 million. This impacts homebuyers in expensive markets and could potentially cool high-end real estate prices. The fifth major change is actually positive for many Americans. The child tax credit has doubled from $1,000 to $2,000 per qualifying child, and up to $1,400 of that is refundable. Plus, the income limits have increased substantially. The credit now begins to phase out at $200,000 for single parents and $400,000 for married couples, up from $75,000 and $110,000 respectively. This means millions more families qualify. But here's what most financial experts aren't telling you. These individual tax changes are temporary and set to expire in 2025, unless Congress extends them. Corporate tax cuts, meanwhile, are permanent. This creates uncertainty for long-term financial planning. So who wins and who loses? Generally speaking, higher income taxpayers without many dependents in low-tax states will see the biggest benefits. The Tax Policy Center estimates that about 80% of Americans will see a tax cut averaging about $2,100. But the benefits skew heavily toward higher incomes. Middle-income households earning between $49,000 and $86,000 will see an average tax cut of about $900, while those making over $733,000 could see cuts averaging $51,000. What should you do? First, recalculate your withholding. The IRS has updated withholding tables, but they might not be accurate for your specific situation, especially if you have multiple jobs or a working spouse. Second, reconsider your mortgage plans. With the new SALT deduction cap and changes to mortgage interest deductions, the tax advantages of home ownership have decreased for many Americans. Third, if you're a business owner, explore whether you qualify for the new 20% deduction for pass-through business income. This could be huge for sole proprietors, S-corporation owners, and partners in partnerships. Fourth, maximize your retirement contributions. With potentially more money in your pocket from lower tax rates, this is an excellent opportunity to boost your 401k or IRA. Finally, consider bunching your charitable contributions. Since fewer people will itemize with the higher standard deduction, you might benefit from concentrating 2 or 3 years' worth of charitable giving into a single tax year to exceed the standard deduction threshold. Remember, tax reform of this magnitude happens only once every few decades. The last major overhaul was in 1986 under President Reagan. Understanding these changes now will put you ahead of the curve as we head into the 2025 tax year, when many of these provisions could change again. The tax code may be complicated, but your strategy doesn't have to be. Plan ahead, consult a professional if needed, and make these changes work for your financial future.